Welcome, and thank you for joining Benetrends Financial. The purpose of this video is to provide you with the information you will need to deal with the plan termination process. After you listen to the entire video, you will be able to make an educated decision as to whether the plan needs to be terminated for you to meet the goals of the business. Let me start by saying that in most of our clients' cases, the plan owns either 100% of the stock of the company or it owns the majority of the stock. The only way you can terminate a qualified retirement plan is by buying back the stock that the plan currently owns. Please keep this information in mind as you go through the rest of this video. For all our clients, there are 3 situations or scenarios that you might be dealing with that will prevent you from beginning the plan termination process. Before you can schedule a call with Benetrends, your retirement plan analyst will be responsible for helping you to make sure that your plan documents and our system have been updated accordingly. The 3 situations include bankruptcy, divorce, or death. Please understand that depending on which of these 3 situations you are dealing with, it may take a substantial amount of time to go through the required process with your retirement plan analyst. Once your analyst has completed the required process, then you will be free to schedule a call here with us at Benetrends. We do realize that any delay is frustrating, but Benetrends Incorporated has to look at your plan the same way an IRS or DOL auditor would look at it. So we must ensure that everything is in order to help you avoid a compliance problem in the future. Please speak with your retirement plan analyst, and they will be able to help you through the required processes regarding each of these 3 situations. Converting out of a C corporation. This idea might have come from you or from your CPA or accountant because they told you that you would be better off from a tax perspective converting your C corporation to either an S corporation or an LLC. When this happens, most of our clients think back to what they were constantly told by the Benetrends sales department and the new business department, which was, this will not work unless it's a C corporation. That idea makes most of our clients think that the only way they can accomplish their goal of converting out of the C corporation is for them to terminate the plan. This is not true. Once our clients invest their retirement money through the plan and into their business, they are free to convert out of the C corporation at any point in time. However, in order for you to be able to legally convert out of your C corporation, you must ensure that the plan does not own any stock of the corporation. The way you can accomplish that is by working with your retirement plan analyst on a process called the stock buyback process. In that process, you will be required to pay an independent third-party qualified appraiser to have them prepare a formal business valuation of your company. Your retirement plan analyst will be able to provide you with a list of 4 qualified appraisers that we refer our clients to. Let's say, for example, that your plan currently owns 100% of the stock of the company and your valuation comes back at $300,000. In order for you to be able to buy back the stock that the plan owns, you will have to give the plan $300,000. This is usually the moment in time where our clients realize why every Benetrends client doesn't do this. Because since your goal is to keep the business open, even if you had $300,000 in your corporate account, odds are you would need to leave the money in that account to keep operating the day-to-day business. If you cannot afford to give the plan the required amount, you will not be able to buy back all of the stock that the plan owns. Therefore, you will not be able to convert the C corporation. For those clients that cannot afford to buy back all of the stock at one time, Benetrends also has what we call the partial stock buyback process. In that process, you would have to pay a qualified appraiser, as an example, once a year for them to prepare a formal business valuation of the company for you. If it takes you 4 years to buy all the stock back, then you will need 4 different formal business valuations. Remember, you cannot convert out of the C corporation until the plan no longer owns any shares of the company. Now, you might be asking yourself, why would any client want to leave the plan open once it no longer has any ownership in the company? Because your plan gives you benefits that you wouldn't be able to take advantage of if you terminate the plan. As an example of this is, in a profit-sharing plan, whenever you make an annual profit-sharing contribution to the plan, you get 2 benefits. Benefit 1 is the total dollar amount of your annual profit-sharing contribution is a tax deduction for your corporation. Benefit number 2 is this provides you with another way you can save money for your retirement. Please speak to your retirement plan analyst about this. But this explains why most clients keep their plans open even after the plan no longer owns any of the stock of the company. Some clients decide that they only want to terminate their plan, but they want to keep the business open, whether as a C corporation or converting out of the C corporation. The majority of our clients keep the plan open until they decide to either close the business and dissolve the corporate entity with the state, or until they decide to sell the business. Since you are the plan administrator, you are free to pick when you want to terminate the plan. But as the supervisor of the plan termination department, we would be remiss if we didn't inform you of an IRS compliance point known as permanency. Please keep in mind that we don't mention this to scare you or convince you not to terminate your plan. We are simply making you aware of its existence in case of an audit by the IRS or the DOL in the future. Permanency is an IRS preference that says, if your plan has been in existence for less than 10 years and you want to terminate the plan but keep your business open, the IRS would prefer that you keep the plan open until whenever you close or sell the business. Since it is simply an IRS preference, you are free to terminate your plan and keep the business open. As mentioned earlier, what may prevent you from this goal is simply that you may not be able to afford to buy back all of the shares that the plan owns at one time. Remember that in order to do that, you will be required to pay a qualified appraiser to prepare your formal business valuation. That document is what determines how much money you will ultimately have to give to the plan. But yes, if you know you will have enough money available to buy back the stock that the plan owns and keep the business open, then you may begin the plan termination process. The majority of our clients terminate their plan when they get to the end of their business life cycle, meaning they decide they want to close the business entirely and dissolve the corporate entity with the state, or they decide they want to sell the business. Please remember that you must complete the plan termination before you dissolve your C corporation with the state. The average cost to terminate your plan may run between $2,300 and $3,000. These fees are subject to change, so please keep in mind that this is just an approximate range and will vary for each individual termination. Here are 3 items that may affect the cost of your termination. Number 1, the ongoing monthly fee, which Benetrends will continue to charge until the future month in which you provide us with all needed documentation for us to prepare your final Form 5500. Number 2, a one-time flat fee to Benetrends that is subject to change in order to terminate your plan. And number 3, the fee the qualified appraiser will charge you to complete your final formal business valuation. If you have a straight profit-sharing plan, expect it to take approximately 3 to 4 months to complete the process. If you have a 401k plan, the reason this can take longer than 4 months to complete is because if you have other employees that have balances in their 401k accounts, you will be at the mercy of how quickly those former employees will complete the required paperwork and return it to you. The majority of our clients will have to pay a qualified appraiser to have them prepare a final formal business valuation of your company. Formal business valuations are only good for 90 days and they all have an effective date. For that reason, we ask that you not get the formal business valuation until after you have formally begun the plan termination process with us here at Benetrends. If the reason you want to terminate your plan is because you are closing the business, the plan termination process will consist of 2 termination packets. In order for us to prepare Term Packet 1 and email that to you, we will need you to tell us what future date you want to use as the plan termination date. The reason it needs to be a future date is because the IRS will not allow you to terminate the plan retroactively. Once you provide us with the plan term date, we will include that date on your Term 1 packet and email it to you. Once we email you the Term 1 packet, we will need 3 items back from you in order to move forward to the next step in the plan termination process. The 3 items are: number 1, a signed and dated Term Packet 1 page dated no later than the plan term date you choose. Number 2, email us confirming once you have paid our plan termination fee. And number 3, email us your final formal business valuation. Keep in mind that it can take the qualified appraiser between 3 weeks to 3 months to complete the valuation. If your formal business valuation comes back at a $0 or negative value, we will be able to prepare Term Packet 2 and email that to you within 48 business hours. If your formal business valuation comes back at any positive value, the next step in the process will require our processing department to complete your final stock calculation. Be aware that due to volumes caused by the pandemic, it can take the processing department approximately 4 to 6 weeks for them to complete your calculation. Only after they complete your final stock calculation will the termination department be able to prepare Term Packet 2 and email that to you. We will also email you a blank year-end questionnaire and census file for you to complete and return to us. In cases where your final formal business valuation comes back at any positive value, you will need to move the required amount from your corporate account to your plan account. Once the money is in your plan account, you will be free to roll it over to any qualified retirement account you like. After you complete all required transactions, you will need to provide copies of the statements to the termination department proving the money has been moved per the instructions they will provide to you. Keep in mind that if you have any other employees that have balances in a plan account, you will need to make sure their accounts get liquidated as well before the plan termination can be completed. Once the termination department has received all the necessary paperwork, they will notify the documentation department. That department will prepare your termination amendment. It will then be sent to you and you will have to electronically sign off on it. Once you do that, the termination department will be notified and then they will submit the request to our processing department for them to prepare your final Form 5500. There are 2 options for you to sell the business, and the one you go with determines who the seller or sellers are, as well as what account you will have to deposit the money into. The first is a stock sale. The seller is, or sellers are, whoever owns stock of the company. In most of our clients' cases, the plan owns 100% or the majority of the stock in the company. You are required to deposit money from the buyer into the plan account. The second is an asset sale. The seller is a C corporation, not you or the retirement plan. You are required to deposit the money from the buyer into the corporate account. If you are terminating your plan due to a stock sale, there are several items for you to be aware of before completing the sale. Most people would say that they would prefer to sell the business by a stock sale. While it's not impossible for you to be able to find a buyer who will be willing to do the deal with you, it is normally a lot harder for several reasons. Number one, in a stock sale, the buyer would end up getting the assets and the liabilities of the company, and as you might imagine, most buyers don't want that. They only want the assets. And number two, if the buyer agrees to do the stock sale with you, it may negatively impact them from a tax perspective. Number three, if you don't have certain language written into your stock sales contract before you sign it the day you go to closing, once you complete the sale, we would no longer be able to speak with you regarding the plan. We would be required to only deal with the buyer. As you might imagine, not only do most buyers not want to deal with the plan, most of our clients wouldn't want that either. These three items give you a good idea as why most businesses that get sold in the US are sold as asset sales and not as stock sales. The key reason people would prefer to complete a stock sale is because you would not have to pay corporate taxes like you would in an asset sale. If your prospective buyer is either related to you or a current employee of the business, you will be required to have to pay a qualified appraiser to have them value the business. That valuation will determine your sale price. For example, if your formal business valuation comes back at $300,000, you would not be able to sell the business to the buyer for less than $300,000. Now, if your buyer is not related to you or a current employee of the business, the IRS gives you the freedom to determine the sale price. Another critically important item for you to remember is that in a stock sale, you cannot allow the buyer to pay you over time. The only way you could allow that is if you agree to complete an asset sale. If you are terminating your plan due to an asset sale, please make sure to speak with your CPA accountant because only they can tell you what amount of money, if any, in corporate taxes you may be responsible to pay if you agree to complete the asset sale. Just like in a stock sale, if your buyer is not related to you and not a current employee of your business, the IRS gives you the freedom to determine the sale price. If you find a buyer that agrees to pay you that amount, you are free to complete the asset sale. The asset sale option is the only option that allows you to let your buyer pay you over time. Most clients that allow the buyer to pay them over a period of time will end up leaving their plan open until whenever in the future the buyer has paid all money owed. That's because many clients cannot afford to pay the difference out of their pockets to the plan. If after you watch this video, you feel that you are ready to formally begin the plan termination process, please let your retirement plan analyst know. They will then email the termination department here at Benetrends. You will finally get a follow-up email from the terminations department inviting you to schedule a call with us. We hope that you have found the information in this video useful, and we look forward to assisting you with your plan termination when the time comes. Your key contact at Benetrends Financial for the plan termination process is available on this slide. Again, we look forward to assisting you and are here for anything you need.